let's turn to crude infrastructure. For those of you who don't know me, I'm Natasha Thomas. I'm Portfolio Manager on Ausbil's Global Listed Infrastructure team. I'm delighted to introduce Bevin Wirzba, the CEO of Southbow, to the stage. So Southbow was carved out of TC Energy in October 2024, creating a focused crude pipeline operator that connects Western Canadian crude supply to the key refining and export markets. Welcome, Bevin.
Yeah, thank you, Natasha.
There's clearly a lot to talk about, especially given the geopolitical backdrop at the moment. But I think let's start with the story behind Southbow, because there's some people in the room that might not know you as well. And so, Bevin, what was the strategic logic behind carving the liquids business out of TC Energy, and how is that thesis playing out so far?
Yeah, so thank you, GLIO and Morgan Stanley, for having us. This is our first time marketing as Southbow down in Australia, and it looks like they used AI to get the gray out of my hair on the picture. So appreciate that. So what's the story behind Southbow? So everyone and many grandparents in North America know about the Keystone XL story, which in 2021 President Biden removed the presidential permit, and that was going to be a significant growth engine for TC Energy, with nearly $1.5 billion of EBITDA in Canadian dollar terms at the time going to be generated. And with the cancellation of that project, all of the capital allocation within TC Energy had to go into gas and power to substitute the EBITDA that was going to come off of the liquids business. And so even though the liquids business was the most profitable component of the broader portfolio, that business was put into hibernation basically for a period of about 5 years and wasn't allocated any capital because TC needed to grow the balance of the business. And as the market and sentiment changed towards infrastructure, and oil infrastructure in particular, from a very negative sentiment at the time of the cancellation of Keystone XL to even fast forward to today, where we've seen a very significant sentiment shift. In 2023, we entered a strategic review of the business, and it looked like the capital markets would be the best way to, through an IPO, create shareholder value. So we went on a journey. I built a team. We assembled a strategy, built a capital structure, went through a shareholder vote and a proxy, and it turned out that since the IPO on October 1st, 2024, we're the top TSR infrastructure player amongst our peer group with tremendous returns, and our shareholder list is very enviable, and we're very happy with what we've achieved. And since the time of spin, we had 3 very basic objectives: get off the TSAs from TC as quick as possible, get alignment with our board on our strategy, and 3, get the right people on the bus in the right roles, pointed in the right direction. And we feel that we've accomplished all those, and we executed our first major growth project, the Blackrod project, and brought that on production, it's moving towards production here on time and on budget. So it's been a great shareholder experience. If you owned TC Energy before the spin and held it, you got Southbow for free. So pretty good outcome.
No, that's great. And you mentioned the growth, which we'll get to, but I think you mentioned the Keystone Pipeline is obviously a key backbone of the system in North America. And just given the geopolitical challenges we're seeing at the moment with the increased shipping and the shipping risk and the insurance costs there, it's really sort of highlighting the importance of that US-Canada energy corridor. And so how do you see Southbow's role in ensuring North American energy security, specifically regarding that heavy crude supply into the US Gulf Coast?
Yeah. So it has been, as I mentioned, a tremendous sentiment shift, and I think even in the not only in the public landscape or even capital markets, but even politically. So in Canada, Canada elected a new Prime Minister, Mark Carney, early last year, with a strong mandate to grow Canada's economy. And the key element of growing Canada's economy is growing its energy sector is one of the key pillars. Foundationally, what we learned as Canada and as an industry in North America is that the tragic events in Ukraine with the Russian invasion, and now just recently with the war in Iran, is that energy security is not something that you should take lightly. And a heavy barrel is what we move. And so when the Keystone system was originally built, there was a tremendous amount of oil sand production that was very economic to bring to market, but no egress to that market. And there was a tremendous demand from the heavy oil refiners in the Gulf Coast for heavy barrels, and they'd been sourcing those barrels historically from Venezuela and the Middle East. But what has evolved is a very robust corridor where it's not just a supply push kind of scenario, it's a supply push and a demand pull. And so the original base Keystone was actually, the concept came from ConocoPhillips to monetize its oil sands assets in Canada into their Wood River refinery. And so that system over the last effectively 15 years has run full capacity for every year because there's such a desire for that heavy barrel to be refined in the most complex refining market in the world, in the Gulf Coast. And so the Canadian barrel has displaced much of those other imports into PAD 3.
That makes sense. And so now we're seeing again, you're looking at sort of growth opportunities, and you've mentioned publicly a desire to triple the size of your business in the next 5 years. I mean, is that supply push what's driving that? Or I guess what opportunities are you seeing across your network to organically grow into that size?
Yeah, certainly it's not growth for growth's sake. We're not just trying to get to 3 times just to be bigger. It has to be accretive to the shareholder, and we continue to say that we're a customer-led strategy. So if you look at our customer set, like the large oil sands players in Canada, so if you think of Canadian Natural Resources, they have the second largest reserves in the world right behind ExxonMobil. Not a small amount of reserves. You have Cenovus, you have Imperial Oil, Suncor, all of those are our customers. And in aggregate, if you look at their quarterly releases over the last half of year, they aspire to grow 1.5 million barrels plus in aggregate. So they need to get those barrels to market, and all the existing infrastructure is effectively full. And so we've been putting forward different solutions that can help bring those barrels to market at the same time. So that is a supply push to your point, but at the same time, half of our customers are on the downstream end, and those refiners are trying to secure those barrels over the long haul. And what's unique about our system is that we're the only market-based rates pipeline in North America on oil, and we are the only batch system. And so we move our product from Canada to the Gulf Coast in a few weeks faster than any other alternative. And the barrel that is moved is the exact barrel that the refinery is asking for. So the product quality is extremely high. And so when you're cracking that barrel, so we've got a demand pull and a supply push. So we're just responding to customer appetite on both the supply side and the demand.
And you've recently announced the Prairie Connector, an open season on that, which is going to potentially utilise some pipe that's in the ground from the old Keystone XL days. Can you maybe just talk a little bit about the vision of that project and how the returns could potentially work?
Yeah. So when we spun out, obviously we got loaded up with more debt than you'd want as a spin company. That's what happens to spins, and we had a big dividend burden. But it's a very sustainable dividend, which gave a great return for our investors. But in our capital allocation framework, our balance sheet strength is number one. And so the way to get there was to invest in our pre-invested corridors. So much of our corridors already had capital put in place. So the Blackrod project that we just are bringing into service, that corridor in Alberta in the Grand Rapids, we already had permitted. We had available capacity, so we could offer a very competitive solution to our customer on that. With the Prairie Connector, we're leveraging the permitted right-of-way that we already have in Alberta and in Saskatchewan, with 150 kilometers of pipe already in the ground, with the most technically challenging component of that route already completed, being a very large river crossing. And as such, we can deliver a project for our customers potentially that is at the very low end of our build multiple range, which would be 6 times EV to EBITDA. Under the same risk preferences that we have today. So when we do projects, when you match a heavy oil sands asset, it doesn't have a decline like a shale basin. It produces flat for over 20 years. And so the terms that we get on our contracts, so the Blackrod project was multi-decade, a Port Neches link that we put in the Gulf Coast was multi-decade contracts, all take or pay. And so when we look at this Prairie Connector, it's at a very low risk with all investment grade counterparties with long tenor. So it matches our profile very well. Now, we've taken a lot of learnings from Keystone XL. I used to say I put my head in a pencil sharpener and it got jammed a few times in trying to do that project. But we've allocated risk appropriately. So we're partnering with US entities to do a portion of the US build out, and then we would connect to our Gulf Coast system, which was a pre-build for Keystone XL. So we're avoiding all of the issues that we had before. We're not holding, as a Canadian company, the presidential permit. We've got partners that are allocating their risk capital to those. And so we're just responding to market demand for that.
Great. And you mentioned capital allocation and the high leverage that you sort of inherited. How are you managing the debt reduction as you have spoken to reducing that leverage while having this sort of growth ahead of you?
So in our cash waterfalls, we've been very careful and deliberate about when we set our initial value proposition through the circular when we went public on the IPO. Looking at our pre-invested corridors, we believed by investing roughly 150 to 175 million US dollars a year, we could support a 2 to 3% EBITDA growth CAGR kind of in perpetuity. And that was because of just even base supply demand, and because we had been in hibernation for 5 years, we had a whole lot of low-hanging fruit to go after. But then since the IPO, with the sentiment shift and our customers wanting to grow, we don't want to sacrifice our deleveraging plans. Right now, Van Dafo, our CFO, is sitting right up here. His tax team helped accelerate a lot of tax optimization, and so we've created more capacity, so we're ahead of our journey on deleveraging today. And we'll be very mindful that if we pursue a large growth project like Prairie Connector, that we'll find a way to finance it that doesn't disrupt our balance sheet goals of being at 4 times by 2028. So we've shared at our Investor Day what kind of financing mechanisms we could consider in order to do so. And we'll match the financing to the nature of the project. And if you had contracted a 20-year contract with investment grade counterparties with a very low risk build in the basically farmland, that's financeable in the debt capital markets likely. It's certainly equity capital financeable. And what many infrastructure players in North America are pursuing now is this insurance capital product or investment grade joint ventures. There's a lot of inflows, which is treated like an equity-like capital source. So we have multiple ways of looking at it, and we'll look at what's the most accretive, but we'll never sacrifice our base capital allocation principle of getting to strong balance sheet.
Great, I think that's what a lot of investors would like to hear.
Yes.
So just before the break, we had an energy transition panel and then a presentation on AI. So I want to hear the question sort of on each, maybe starting with AI and just the use of AI. How is South by either utilising AI or advanced monitoring sort of technology just to improve leak detection and operational efficiency across your pipeline network?
Yeah, it's a great question. And, we had a lot of hard things to do during the spin, but a lot of opportunity comes with that. A lot of energy infrastructure companies get built over decades and decades and decades, and their infrastructure on IT can get to be what I call to our team like a Frankenstein. We got off Frankenstein and we created our own ERP system and our own IS and IT architecture. So we're a clean Microsoft firm that relies on Microsoft Dynamics, but in that we're able to leverage all the cloud and AI tools to now we've been accelerating our utilization of that. So we put in a leak detection logic system, which effectively can shut down the system in less than half of the time of what we can do physically. We've done predictive analytics, have that built in, so all the failures on pump seals or any operational things are now predicted. We've reduced costs in terms of now we're building out AI logic around our scheduling and optimization, utilizing power. Texas and Alberta are the two deregulated power markets across our system. And so predicting when there's bad weather and otherwise turning down pump station capacity during peak loads can lower operating costs. So, and then whether it's the legal group or the HR group or any group, we've been able to deploy kind of learnings on creating agents. I was, mentioning earlier to an investor this morning that, I have an agent that scrubs all the 30 emails that I used to read from the sell side, and it just gives me a nice simple note in the morning. So sorry, I'm not taking away the work of the sell side, but it gives me all that in basically, I can read it in 10 minutes as opposed to using the first hour of my day to try to read all the notes. So we're trying to leverage that across the company.
Great. And then just on energy transition, how has your investor base evolved their thinking on crude pipelines over the past couple of years? And then just thinking ahead, are there opportunities for South Bow to play in the carbon capture or biofuels space using your existing rights of way?
Yeah, so back in 2021 when Keystone XL was canceled, we did a strategic review at that point. There was no way we could have sold the asset, couldn't have get any kind of equity or debt capital markets to do an IPO or a spin or anything. That like investor sentiment towards oil and oil sands was at its at lowest levels. Since then, as I mentioned, that sentiment has shifted, but that hasn't really changed our emphasis on kind of our approach to ESG. The liquids business was actually going to be the tip of the spear for TC to advance their emissions reduction because as our systems are completely tied into the electrical grid, so we don't have emissions. We're already a zero emissions business, and we could source renewable contracts for power on a virtual basis or a synthetic basis, which could make us a net zero asset, which is fairly unique. And when we look at our shareholder base, if you would have told me, 3 years ago that I would have a California pension investing in us today, I would have said that's impossible. You're trying to trick me. And we have a large California pension in our investor base. And when we talked about growing with Prairie Connector, they were very excited. So we've seen a good sentiment shift, and I think it's because of the growing realization that we're going to need this energy source for decades and decades to come. And the source of our supply, our upstream oil sands producers, they have an oil sands alliance. They used to be called the Alberta Pathways. Now they're called Oil Sands Alliance. They're putting the largest carbon capture and CCUS basically system in the world, making the heavy barrels that will be moving the cleanest barrels in the world. And so collective with our system, it's quite an attractive asset from an ESG perspective.
That's great. Before I turn to the audience for questions, I thought I'd just ask one get to know the CEO question. So when you're not thinking about throughput and capital allocation, what do you like doing the most, and are you competitive at it?
Well, I have a lot of hobbies when I have time for them. I think cooking is the thing that I've done the most of my entire life, and I don't go on cooking shows or competitions or any of those things, but I hold myself to a high standard, and I like to do that. And I've any kind of cuisine from African to Asian to whatever I've tried and delved into. So my biggest collection is cookbooks. So that's and I just strive to try to learn and do the best I can at it. So.
And now you can probably get an AI agent to put all those cookbooks together for you.
Yeah, but it's fun to hold the real book. Yeah.
Does anyone in the audience have a question? I've got more, but I just thought I'd see. No? Well, I don't know where we go from the cookbook, but
Yeah, that's it.
maybe just thinking about sort of leadership and culture, because you've got a new company, but in a sort of an old industry, the sort of midstream industry. And so what is one thing you want every Southbow employee to have in mind when they show up to work that differentiates your company from the rest of the industry?
Yeah. So when we started, you know, we're trying to get ready to spin an IPO of the company, and then right post the spin, you know, we're busy trying to get off of the TSAs. But through that period of time, we did a first kind of session with our leaders where we tried to create a base set of values we could all rally around. And we did it very quickly, and then we realized about a month later, let's just throw it out. Because it was horrible. No one actually bought in. So we got everyone together again, and we actually aligned on 4 values that sound simple but are profoundly impactful to our company. And one is we are safe. Second is, you know, we do the right thing. Third is we're proud. We take pride in what we do. And fourth is we win as a team. And each of those, I can give you multiple proof points of how different those are to many corporate entities. And the reason why we have those 4 values is we want to, you know, have everyone act as owners, feel like they're part of the entire mission, and we win as a team. But really what we need to be is, you know, we're a critical infrastructure, so we have to be safe, and we have to be low cost and efficient to be competitive so that we can grow and thrive. This market, as you all have seen, is a consolidating market, whether it's in consolidation within asset management communities, but even corporate worlds. So if we're not growing, we'll be the growth for someone else. And we've really connected. We've translated those values and you know, our vision into, we created what we call our light post. Where do we want to be in 5 years? And so at the Investor Day, you'll see in the slides that we've listed all the attributes by operational, financial, capital markets, and what we aspire to be. And so all our plans, anything that we do has to get us closer to that goal, and anything that pulls us away, we stop. And you know, we've lived it, we've changed out. It meant, by using those values, it meant we changed out 4 officers already in the first year. But that allowed us to get to the right team that has the right vision. We've rationalized the part of the business. We've changed the way we did things. And we're having tremendous ownership and success along the way. And so we feel that we've created a real ownership mindset, where the shareholder experience is the same as the ownership or the operator experience.
Great. Maybe just the last one. What do investors, or what do you think, what do investors most commonly misunderstand about your business?
I think the most common misunderstanding is many infrastructure players are either on a more rate regulated basis. We're a purely commercial business. We just have commercial contracts. So that necessitates us being with that mindset. We have no commodity exposure. That's another thing that a lot of investors assume, that the price of oil up or down impacts us. We're just a highly contracted provider of infrastructure. And I think that the third misconception is that because we're small and a spin out, that we can't grow and thrive and compete against the large caps. And you know, when we created our team and our board, if you look at our board and the complement of our team, we believe, and we are going head to head against the Enbridges and the others, and we believe that we're more nimble and flexible and we can win. So there has been, you know, oh, you're the spin out, so you must not be a very good business, or you must not be profitable. And we've already proved a lot of those investors wrong. like at the time of spin, before the marketing and getting to the lead up, common things were you're going to trade at like an 8-time multiple, you have a single asset risk, what's going to happen if you have an incident? Well, we've proved that we can do all of those things and more. And so I think we've demonstrated that we can have this company be enduring for the long haul. And it's a fun place to work. So that's good too.
That's great. Just last call for any questions? There's one at the back. Just wait for a microphone, I think.
Just two very quick ones. In midstream, you always talk about build multiples and fair value multiples. So just run me through that. So you say you can build a new asset for 6 times EBITDA, whatever the run rate.
Yeah.
And then it reverts to a fair value of whatever you trade at 10 times. Help me translate that into project IRRs, because that's how we tend to think about them here.
Okay.
Because I know you're making great returns, but I just can't get my head around
Yeah, I had to convert into that language.
Yeah,
I grew up at Chevron with IRR drilled into me. I did the investment guidelines for Chevron globally back in
and
early.
And the second one is simply very simple. How is under Carney, how is Ottawa coordinating better than with Alberta? Because I know it was very difficult in the past.
Yeah.
Is it a bit more functional and seamless now, or not really?
Yeah, so a 6-time build multiple, so what that means is for the EBITDA that Blackrod spits out, it cost us 6 times that EBITDA to build. And right now we're trading at around 11 times. So the arbitrage there is we're creating value on that gap between what it costs to build that, grow that EBITDA. And if we go on the inorganic side, you're likely have to pay your multiple or near the multiple for a lot of assets. And so it's less accretive in most cases unless it brings other synergies to it. On an IRR basis, if you took a 6-time build multiple, it's roughly in the 12 to 13% IRR. Take or pay contracts, so well above our cost of capital of around 7% right now. So we're almost earning double our cost of capital in this market. So very economic. So I put it in my PA, obviously, because I think it's, with our yield, when we came out, you get the company for free every 6 years. So it seems like not a hard thing if you're reinvesting the dividend. With respect to Alberta federal government, when the federal government came in Canada, I got a call right after from Minister Hodgson, who's our natural resource minister. I get texts from him and the finance ministers. The federal government's actually talking to the Alberta government. That MOU came together in the fastest I've ever seen. They've set a goal of April 1st to have the standards around carbon, basically carbon pricing, and that oil sands alliance, that goal line will not be missed. And so they're making great progress, and that relationship is strong. And I think it's because the federal government realizes we need our GDP to grow. We also have a trading partner that's decided they want to trade differently than they have historically. So we have to develop new markets. And so that alignment between the federal government and provincial government has been very, very strong. I hate to say it, when I was working on Keystone XL, the original version, I went to Ottawa right as President Biden was coming in. We were trying to make a grand bargain, and the energy minister at the time looked at me and said, "Sorry, we can't support you, but Bevin, who would even use your pipeline in 4 years?" So we have a very different understanding of the importance of energy in our country, and very, very strong alignment with our province. So it's a very, very different environment. So thanks for the question, and thanks for everyone's time. I know we're over. So
yeah, thanks, Bevin, for your perspectives today.
Thank you, Natasha.
Right, thanks.